What if I told you that the biggest real estate crisis in 2008 is about to create more millionaires than any market shift in the last 50 years? Right now, $290 billion in commercial real estate debt is about to hit a wall. Office buildings worth hundreds of millions are trading for pennies. Banks are quietly preparing for massive losses, and major real estate empires built over decades are crumbling in months. But while the mainstream media focuses on the crash, institutional investors, the same ones who got rich in 2008, while everyone else begged for loans, are positioning for the wealth transfer of a lifetime. They're not panicking, they're preparing. And if you understand what I'm about to show you, you could be on the winning side this time. So I'm going to break down exactly what's happening behind closed doors in commercial real estate right now. I've personally underwritten hundreds of millions in real estate transactions, worked directly with institutional capital, family offices, and private equity groups who control some of the largest multifamily portfolios here in Virginia. So hit that subscribe button if you want the kind of market intelligence that separates the wealth builders from the wealth losers. Because what I'm about to reveal isn't making headlines yet, but it's about to reshape the entire real estate landscape for the next decade. This isn't theory, this is what's happening in boardrooms and investment communities right now. So let me take you back to 2008 for a moment. Everyone remembers the housing crash, the bank failures, the economic meltdown, but here's what most people missed. While homeowners were losing their homes, the regular investors were getting wiped out. Institutional capital was quietly buying distressed assets at 30 to 50 cents on the dollar. Blackstone bought 40,000 single-family homes between 2012 and 2015 for an average of $150,000 each. Today, these same homes are worth $400,000 plus. They didn't just survive the crisis, they used it to build the largest single-family rental empire in history. But here's the difference between 2008 and today. Back then, the crisis started in residential housing and spread everywhere. This time, it's starting in commercial real estate, specifically offices. While residential housing remains structurally strong, that creates a massive arbitrage opportunity for investors who understand where capital is flowing. But here's the iron law of institutional investing. Capital always flows from declining assets to appreciating assets, from complexity to simplicity, from uncertainty to predictability. And right now that flow is pointing towards one asset class, multifamily real estate. Let me show you exactly why this is happening and how the smart money is positioning for the biggest real estate profit opportunity in decades. Here's what nobody is talking about. Between now and 2027, $2.8 trillion in commercial real estate debt comes due for refinancing. That's not a typo. $2.8 trillion, to put that in perspective, that's larger than the entire GDP of most countries. But here's the problem. Most of that debt was written at 3 to 4% rates in 2021 when the Federal Reserve had its interest rates at zero and was printing money like there was no tomorrow. Today, banks are charging between 7 to 8% for the same paper. Some deals are seeing 9 to 10% rates, and if there's any complexity or risk involved. So let me give you a real example from a deal I recently analyzed. A $100 million office building bought in 2021 with $70 million in 3.5% debt. Annual debt service $2.4 million. The building was generating $8 million in NOI, so debt service coverage was comfortable at 3.3 times. Today, that same $70 million at 7.5 rates, $5.25 million annually in debt service, that's an extra $2.8 million per year just in interest payments. But wait, it gets worse. That office building isn't generating $8 million in NOI anymore. With remote work, higher vacancy rates, and tenant downsizing or not renewing leases, it's probably closer to $6 million. So now you have a $6 million in income against $5.25 million in debt service. That's 1.14 debt coverage ratio. Most lenders require 1.25 minimum. Many want 1.35 or higher. So this owner has three choices: inject 10 to 15 million in fresh equity to pay down the debt, hand the keys back to the bank and walk away, or sell the building for whatever price someone will pay cash is willing to pay now. Guess which option most are choosing. And this isn't happening to one or two buildings. This is happening to thousands of office properties across the country. In Manhattan alone, office building sales are down 75% from historical averages because nobody wants to buy at current prices, but the debt is still coming due, which means we're about to see the largest forced liquidation of commercial real estate in modern history. And that's where the opportunity gets interesting. Now, here's where the crisis becomes a wealth building opportunity for those who understand the game. When institutional investors are forced to sell office buildings at 50 to 70% discounts, where does that displaced capital go? It doesn't disappear. It rotates into asset classes that offer safety, yield, and growth potential. So let me walk you through three phases of this wealth transfer. Phase 1, distressed office liquidation. See, institutional owners, pension funds, REITs, insurance companies liquidate office buildings at massive discounts just to clean up their balance sheets. Smart buyers with cash acquire trophy assets for fractions of replacement costs. Phase 2, bank portfolio cleanup. Regional and community banks holding $290 billion in commercial loans start marking down their real estate exposure. Some banks fail and get acquired by stronger institutions. Others raise capital at lower prices to shore up their balance sheets. This creates opportunity to buy bank stocks at discounts and acquire loan portfolios at steep discounts. In phase 3, the great rotation. Institutional money that's been sitting in cash, bonds, and declining office assets start hunting for real income-producing assets that can deliver consistent returns. So where does $2 trillion in displaced capital go? The asset class that offers the best combination of yield, growth, and necessity: multifamily real estate. Because just think about it. Stock market all-time highs, overvalued and risky. Government bonds paying 4 to 5%, barely beating inflation. Corporate bonds, credit risk increasing. Office buildings, toxic waste. Retail shopping centers still fighting e-commerce. Industrial warehouses overbuilt and cooling. Multifamily apartments, essential housing with 6 to 8% cash flow yield, built in inflation protection through rent increases and demographic tailwinds from the largest renter generation in history. So this is why the smart money is making the biggest bet on apartments in decades. So this isn't speculation. Let me show you exactly what institutional capital is doing right now. So Blackstone just raised $30 billion for real estate investments, the largest real estate fund in history. Their target: multifamily properties in high-growth secondary markets. Brookfield committed $15 billion to multifamily acquisitions over the next 24 months. Apollo Global Management launched a $25 billion real estate credit fund focused specifically on multifamily debt. KKR, Carlyle, Starwood, they're all loading up. But here's the key insight. These aren't desperate moves by institutions trying to save failing strategies. These are calculated bets by the smartest capital allocators in the world who see what's coming. You see, they understand that when $2.8 trillion in commercial debt needs to be refinanced or liquidated, the capital rotation will be massive, and they're positioning ahead of that wave to capture assets at today's prices before the rotation drives value higher. Think about it. If you knew a tsunami was coming, would you run to higher ground or wait to see what happens? Institutional capital is already running to higher ground. The question is, are you? Now here's where most investors get this completely wrong. They think multifamily is good, and start buying any apartment building they can find in any market at any price. And that's how you lose money even in a good market. The secret is location and timing. Not all markets will benefit equally from this capital rotation. And here's what institutional investors are specifically targeting: secondary markets with population growth above 2% annually, job diversity beyond any single industry, median household incomes of $75,000 or more, and affordable cost of living relative to major gateway cities. Places like Richmond, Virginia, Tampa, Florida, Nashville, Tennessee, Charlotte, North Carolina, Austin, Texas, Raleigh, Durham, Jacksonville, Florida. Markets that offer the growth dynamics of major cities without the overinflated prices that kills returns. So why secondary markets? Because institutional capital has already bid up apartment prices in New York City, San Francisco, LA, and Washington, D.C. to levels where even 8% cap rates, the risk-adjusted returns don't justify the capital deployment. But in Richmond, you can still buy Class A multifamily at 6 to 7% cap rates with clear pathways for rent growth, operational improvements, and value appreciation. Here's a real example. Last month, I analyzed a 150-unit Class A property in Richmond's West End submarket that traded $225,000 per unit. Comparable quality building in Northern Virginia, $350 per unit. That's a 55% discount for being 90 minutes south of Washington, D.C. But local arbitrage is only part of the story. The bigger opportunity comes from understanding demographic shifts that are permanent, not cyclical. Here's what's happening. Millennials and Gen Z, the largest generations in history, are entering their prime household formation years. But here's the problem. Mortgage rates at 7% have priced out an entire generation of potential home buyers. A typical millennial making $75,000 annually could afford a $350,000 house at 3% rates. At 7% rates, they can afford a $200,000 house. But those people didn't disappear. They didn't stop needing housing. They didn't move back in with their parents. They became permanent renters, and permanent renters are in their 30s and 40s with good incomes, with the highest quality multifamily tenants in the market. They sign long leases, they pay on time, take care of the properties, and tolerate modest rent increases because they understand it's still cheaper than owning. So how do you position yourself to benefit from this massive wealth transfer? Strategy 1. Target the transition markets. Look for cities where office buildings are struggling, but multifamily fundamentals remain strong. These are markets where you can acquire quality assets before institutional competition drives prices higher. Strategy 2. Focus on cash flow, not speculation. In uncertain times, institutional investors pay significant premiums for assets that generate income today, not pie-in-the-sky appreciation plays based on optimistic rent growth projections. Target multifamily properties with current 6% cash-on-cash returns based on existing rents and operating expenses. And strategy 3. Think like institutions. Don't chase single-family rentals or small duplex deals that require constant management and offer limited economies of scale. Target 50-plus senior properties where you can achieve professional management, operate efficiencies, and the kind of institutional quality reporting and returns that attract serious capital partners. Strategy 4. Structure for the entire cycle. Use moderate leverage, 60 to 70% LTV maximum. Keep 20 to 30% of your investment capital in reserve for additional opportunities. Partner with local operators who understand sub-market dynamics, tenant preferences, and operational best practices. Strategy 5. Time your entry for maximum advantage. The institutional capital wave is building now, but hasn't fully deployed yet. You have maybe 12 to 18 months before this opportunity gets priced out by institutional competition bidding against each other. The investors who build generational wealth from this crisis won't be the ones swinging for home runs. They were the ones who execute disciplined, repeatable strategies at institutional scale. So here's a critical reality check. This wealth transfer is already happening. The distressed office sales started 6 months ago in secondary markets. They're accelerating in primary markets now. Institutional capital deployment is ramping up every quarter. The multifamily and premium and target markets is expanding every month. So you have maybe 12 to 18 months before this opportunity gets priced out by institutional competition. And after that, you'll be competing against Blackstone's $30 billion fund, sovereign wealth funds with unlimited capital, and pension funds desperate for a yield in a low return environment. And guess who wins those bidding wars? This isn't meant to discourage you. It's meant to create urgency around the window of opportunity that exists right now for sophisticated individual investors who understand what's happening and can move with precision and speed. The $290 billion commercial real estate crisis isn't just a headline, it's a redistribution of wealth happening in real time. Capital is flowing from declining office buildings to essential residential housing, from over-leveraged regional banks to well-capitalized institutional investors, from speculative development projects to cash-flowing operational assets. If this analysis opens your eyes to what's really happening in real estate right now, smash the like button and subscribe for more market intelligence just like this. Drop a comment and let me know. What market are you targeting for your multifamily investments? Are you seeing the same patterns in your local area? Because the opportunity is massive, but the window is narrow. The institutions already know what's coming. The question is, will you benefit from the biggest wealth transfer in real estate history, or will you be watching from the sidelines, wondering what could have been? Because the choice is yours, but choose quickly. History waits for no one.